All right, good morning. Today is July 13th, 2022, and I'm back with another edition of the Wednesday Live Show. And of course, as everybody knows, the big story this morning is that year over year inflation rate is came in at a blistering hot 9.1%, which is the highest inflation rate in 41 years. Wow. And there's a lot to say about it, and of course, you probably, if you watch CNBC like I do, sometimes I watch it a little bit, and I typically keep the sound off. But there's a few people that I like to listen to their takes on these kind of things. But that was the big number everybody was looking for, and so it was a shocker, right? And so the idea is that now all of a sudden, I mean, literally since 8:30 this morning when the inflation number came out, now there's talk about the Fed rate hiking, a full 100 basis points in their meeting in July, which is the Fed announcement, I believe, is 2 weeks from today on July 27th. So prior to today, they were expected, they've basically telegraphed a 75 basis point rate hike, and I'm starting to lose track. Right, so this would be the last one was 75. The one before that was 50, and then I think they started at 25, and then there was either 150 and a 75. I don't know, but anyway, big scheme of things. Um, and then the other interesting point is, and so real quick before I move on to the other interesting point is that if you were watching the market this morning when that number came out, at first for like I don't know 10 seconds the futures like spiked higher, and then they just tanked, right? And so that was like a really sort of weird anomaly, and that was, boy, I don't know what to make of that. But it was really something to see, like on a 1 minute chart. So just really crazy market behavior. Um, for the S&P futures to rally like about 40 points, spiked straight up and then dropped and ended up like 100 points, from that peak. So that just goes to show, trying to trade around these economic releases can be extremely risky. But that was one of the craziest things I've seen in all the years. Maybe not crazier than the flash crash, but it was close. Just that initial reaction in the blink of an eye. Anyway, so the inflation numbers highest in 41 years, this and that, and so now the the big talking point here is that we've seen commodities and gas come down considerably since June, right? The price of gas here, it never hit $5. Oh, by the way, let me get rid of this and go to. Before we talk about the S&P, though, let me finish my thoughts on the 9.1% inflation print is, and so what everybody's going to come on TV now, and I've already heard this, obviously, and I was thinking the same thing yesterday because I don't know if you saw this, but yesterday there was a pre-warning by I think it was the press secretary pre-warning that inflation numbers may come in higher than expected. So the expectation was 8.8%. It came in, which seems, insanely high, but came in at 9.1%. But here's the thing that everybody's going to be discussing today is the fact that commodities have really come down considerably in the last month, and so the big question is, has the rate of inflation peaked? And the answer is that, well, obviously it's hard to tell, but there's a pretty good chance that next month or whenever the next numbers come out, like July inflation will be lower than June because of the fact that energy prices have come down considerably, and copper prices and lumber prices and the price of everything. And so, that's what Kramer keeps saying anyway. And he's actually right. I mean, if you watch this stuff, the prices of all of these basic materials have come down. Now, the one thing is one of the biggest contributors to the inflation rate is owner equivalent rent. And so whether that's come down or not, that's a whole different story. And I honestly have no idea, but just kind of basic logic says that since all these commodities have come down, that the next inflation print won't be, over 9.1%, right? And then everybody will say inflation has peaked, but keep in mind that a year and a half ago, or whenever, a year ago, year and a half ago, when inflation was, 5%, they were telling you that it was transitory, right? So, and of course, everybody is starting to realize that the cause of all this inflation was the fact that the Fed, doubled the money supply in a short amount of time. They create money out of thin air, and inflation, if you read the historical economic textbooks, is it's a function of monetary policy. And so, I mean, it kind of makes sense. So there's lots of crazy stuff going on. Anyway, real quick, the S&P had a fairly significant gap down, and it's trying to hold around the open. It's actually a little bit above the open right now. So I want to leave this chart up here. I was going to go to the SPY because the S&P doesn't show the open, but I want to take a real quick look at the bigger picture. So, we all know what happened when this trend line broke, and right now this is the I would call this like the primary overhead resistance trend line, and we're a long way from that. And so lately I've been inclined to to draw a trend line sort of down across these highs here. And well, and so the thing about these steep trend lines, the steeper the trend line, the less reliable it is. And so this steep trend line here, the market just traded, chopped around sideways in this range for a couple of weeks. It's going to break this trend line, but it can still be, kind of useful if you zoom into it. And I don't think I drew it perfect, but I mean, it's still, it's still an overhead resistance line. I would say that there's another sort of a parallel line, and this one's even trickier to draw, but you could draw sort of a parallel line to this one. Actually, it's not really parallel, but it's just kind of a big down channel. So I mean, there's all kinds of different things you can do with these trend lines. I suppose you could I see some people like to actually draw parallel lines. So you could draw a parallel line like that, but fact of the matter is that the market's still in a downtrend. And so, as annoying as it is, that's why I just left this trend line here and playing with it. There's also kind of a bear flag here, right? If you look at this, and today we're kind of poking at it, but you can see like this little just current pattern since this sell-off is forming, sort of a little bit of a bear flag. So we'll have to see what happens with that. Hey, the thing about the very short term is each one of these little rallies, like this rally here, it filled this first gap, right? And each one of these little rallies, as I recall, it seems like the consensus is that the lows are in, and that the lows are in, and the market's going to rally back up, and eventually we may get some sort of another rally like we had back here. Let me bring this down just a little bit. See, it bugs me when my trend lines aren't actually touching. So there we go. That looks a little bit better. this rally back here in early June, actually started in late May, early June. That was a unusual sort of consolidation pattern in that it lasted so long inside of this range. And I remember at the time the consensus was that was going to break to the upside, and then we were at least going to like test 4,300. I mean, that seemed like the conventional wisdom. And the thing about it is, what no one really talks about is how time is such a factor when it comes to looking at charts. Like I can bring up a weekly chart or a monthly chart. Nothing happens fast on a monthly chart, right? And so what happens is, like, we got this rally and then it kind of held, and every time it would get to the lower end of the range, they'd bid it back up. And so, you go 2, 4, 6, go 8 trading sessions. After a rally, you consolidate for 8 trading sessions, and the conventional wisdom then is that when it breaks out, you get a continuation move in the same direction. So that failed miserably, right? And so my point here is that these last couple of rallies, like this one and this one, um, you hear a lot of talk about how, okay, the lows are in, and markets, priced everything in. That's another sort of recent phenomena. So, I mean, here's the thing is, other than, the pandemic sell-off, which happened extremely quick, nobody had time to catch their breath before the market tanked, and it was a time of turmoil. And so this is a little bit different now because you theoretically you got we're in a bear market since the beginning of the year, right? We've had the bear market sell off, and it's acting like a bear market. Lower highs, lower lows, right? And speaking of lower highs and lower lows, I mean, you got a pretty good string of lower highs and lower lows. And of course, there was this rally in March that made a little bit higher high than these previous ones, but of course, it was lower than this one. So any way you want to look at it, I mean, this is still a really tough market because the sectors that were doing so well, which is energy, right? Energy and materials. Those were the sectors that were bucking the trend, and everybody was getting into and doing so well. And of course, they've been just obliterated recently. And so that's sort of like what happens in a bear market. You get rotation, you get false rallies that get sold. Um, Instead of people buying the dip, they're looking to get short on rallies, that type of thing, I would guess. And so the other thing I was thinking about this morning is that for, geez, I mean, so many years now, um, you know, your average investors have sort of been conditioned, like Pavlov's dog, to buy the dips, right? And every dip's a buying opportunity, and if you buy the dip and it goes lower, you buy a little bit more, and then everybody's, I mean, literally on every uptick, every day that the market rallies a little bit, CNBC asks if the low is in. Are we near the lows? Have we seen the lows? Every guest, right? And so I don't know. It's kind of But here's the thing: is that generally speaking, with a stock, um, this goes back to what I was saying before. Like, V bottoms aside, and see, that's another thing too. I mean, back in the day, over the years, I don't think V bottom reversals were as common, especially something like this. I mean, I suppose after a panic sell off, and here's the thing. Looking at this, this rally off the pandemic lows is why we have so much inflation now, right? Because the Fed went crazy and they threw trillions of dollars at the problem, and so now those trillions of dollars are watered down the money supply basically. And I know I don't know enough about, bank reserves and all that kind of stuff, but all I do know is that um, you know, any economist should have seen it coming. The thing that gets me is all the, and I'm not talking about just the past couple of years. I mean, pre-pandemic in like 2018, the CPI was rising, and they were saying that there was no inflation. And remember, they were struggling to get to their 2% inflation goal, and this and that, and wringing their hands, and they were just determined to do, what they could to get inflation to 2%, and they were pretending it was below 2%. Meanwhile, I'd go to the store and the price of everything I was buying was going up. And so I didn't believe them back then that there was no inflation. And I mean, during the Trump administration, I remember Larry Kudlow coming on CNBC, standing in front of the White House, telling me there's absolutely no inflation. There was that article on CNBC that said RIP inflation. So anyway, I saw it coming a mile away. Obviously, there's nothing I could do about it. But the thing of it is, everybody knows that the cost of living constantly goes up and has been going up, even when they were trying to convince you first they tried to convince us there was no inflation, even though the price of stuff that you buy on a normal basis was going up. Think about your health insurance policy, right? The increases on that. And think about the increases on, obviously you've seen the charts, medical care, hospital, anything medical related, the price of drugs, pharmaceuticals, and college education and home prices. I mean, that was the big tell. They were trying to pretend there was no inflation, and meanwhile, the price of homes has been rising for years and years and years at, well over double digits. And so, anyway, long story short, 9.1% inflation is probably, it's probably that's going to be the peak, I would say. And another thing is that obviously the way to fight inflation, no one wants to admit it, but is a recession where people quit buying stuff and just discretionary spending comes down. So anyway, and that's probably where we're headed, because that's just how things work. But anyway, as far as the S&P goes, geez, I mean, it's hard to. I could draw some fibs on here, which I'm not going to do because trying to mark up these charts gets kind of annoying. But anyway, you could draw a trend line down across these highs. That high across that high is pretty decent. Let me try that while I'm zoomed in here. Let's see, what was I going to do? Yeah, I'm not particularly. I mean, that's not the greatest trend line right there, or you could draw one like across these highs. That's not a very good one either. Let's see, I suppose you could draw one from there to there. Anyway, here's my point is, that might be a reasonable trend line. I mean, the whole idea is that, and I see people draw trend lines all over the place on the charts and channels and different things, but the whole point of it is this is not a bad overhead resistance line, and that's basically what it is. It's just sort of an overhead resistance line, and then of course there's the way I look at it, I sort of like levels, right? I almost prefer levels to trend lines. Although, certain trend lines that have really good fits can be attractive, but obviously like right now, these recent highs right here, I've been saying for a while that, 4,000, like it's hard to get excited about the market until it can get back above 4,000. And so right now I would say that, this low down here is probably, well, I mean, it's hard to say. I mean, that low could potentially be in jeopardy because every single low that we've seen so far this year and rally off of it, everyone wants to believe that the lows are in, but so far, and of course we got a little short term, we got a little bit of a higher low here, but that's sort of in jeopardy. And so I would say, range here between, what's this, about 39.50 and right here, if these lows right here break, then then you're one or two sessions away from the actual lows breaking. And so I would say that right now we're just in like sort of a congestion area. Call it 37.25 or whatever these lows are. Let's see see what the low of this day is right here. Well, 37.38, 37.42. So yeah, 37.25 is close enough, but actually it's 38. Yeah, and so that's basically what needs to hold here. Or you could back it down a little bit. Yeah, you could almost pull it down to these days here, call it 37.25. So there's a couple of 100-point S&P range here, and so the next big move is going to come from there. Keep in mind, like I said before, this kind of looks like a bear flag a little bit, or you could, on a shorter term basis, you could turn it into a little triangle. That might even actually be a better fit. So there's the upper part of the triangle, there's the lower part of the triangle, and it is breaking to the downside as we see here. So unless we bounce from tomorrow, or bounce the rest of the week, but anyway, it's a little consolidation area. Let me just get rid of that, and let's one quick look at the bigger picture here on the weekly chart. And so, I mean, the weekly chart looks kind of nasty, right? It really does. Like this little consolidation I was just talking about here for a few weeks, up, down, up, down, up, down. We're down towards the lower end of the range on that. And so, I mean, it remains to be seen whether there's another leg down, but 3,500 doesn't seem out of the question, because it kind of lines up with some levels from back here, maybe a little bit higher, but back over here when we had a couple of sell downs and then bounced. So anyway, there's the bigger picture, and so that's pretty ugly, and that's not even, I mean, S&P down roughly 20% from the all-time high in the history of the world is not reflecting the underlying damage in the overall market in individual stocks, right? And so, I got a whole watch list of stocks over here. Let me just give you an example. AMD, right? AMD, since the beginning of the year, this is a darling stock, right? This was one of the big sort of success stories of recent years here. I remember when this thing was $2, right? And so, let me see what's happening here. There we go. Want to get the date axis on here. Yeah, and so I mean, it's just back of the napkin math here. 150 to 75 means that AMD's lost half its value this year. Right? And I mean, just on and on and on. On and on and on. You can look out there at what were former high flyers and or Wall Street darlings, and the semiconductors like NVIDIA. I mean, semiconductors had humongous gains, and they were like, widely owned. I mean, seriously, how many institutions, have been holding NVIDIA? And so, anyway, and it's pretty easy to see on that. There you go. NVIDIA is another one. You can see right at the beginning of the year here, thing was $300, now it's 150. And so, I mean, a 50% drop in something like AMD and Nvidia. And then, I mean, the damage, it goes on and on. And it's not just small companies. I mean, look at Boeing, right? I mean, Boeing, quite frankly, look at that. Well, there's the pandemic sell-off, and look at where it is in relation to that. That's another thing I like to look at when I'm going through the charts. I like to look and see, and that's why I always zoom out to the pandemic sell-off, because I like to look to see where a stock is in relation to that. Um, I remember years ago, I don't remember, could have been 5 or 10 years ago, but I remember years ago, CNBC did some sort of special, maybe it was the Dow 20,000 special or whatever, but they went back to like the beginning, or, they went way, way back, and turns out, and I just remember this, that Boeing was like the number one performing Dow stock over super long period of decades. And anyway, the real damage is like Facebook, right? I mean Facebook. Look at this. Um, and here's another one where you can see where it is in relation to the pandemic sell-off. And so, you know, the market itself is still way up, close. It's kind of close to the highs. Maybe it's halfway in between the highs and like where it was before the pandemic sell-off. And see, that's the whole idea of this exercise is where where are things in relation to before the pandemic, right? Because that sell-off and that rally kind of changed everything. And so, but it's crazy because the market cap, right? The market cap of Facebook, and of course now they've changed their name and their ticker symbol and everything, but I mean, you don't hear much about Fang. Netflix was a Fang stock, right? This is incredible. I mean, the decimation of Netflix is, well, it's just a good eye opener, right? It is, because I mean, Netflix did great for years and years and years and years, but when things go wrong, look out. And so this is sort of typical of, some of the high flyers. I mean, this thing was $700, and now it's 170, 171. And so that, geez, I don't know. I mean, this is one of the things where you get these analysts that are bullish on a company, not based on the story, right? The story of a stock. And so, same with like Meta and Netflix, and they don't go by the charts or draw lines or, say, hey, this looks like a Head and Shoulders, and if this line breaks, we're selling. I mean, they develop, whatever their metrics are and value these companies based on whatever. But yeah, so I don't know. I mean, do they continue to hold this thing? Right. Speaking of which, ARK, is this is the one that I like to use, as you know, and I say this every week, but it's still true. I like to use ARK as a proxy for the growth stocks and momentum stocks and the new paradigm stocks, right? And so there you go. Um, it's managed to sort of settle in this little range that is, geez, it's closer to the pandemic lows than anything else. And so when ARK finally, eventually, if it does, I mean, if things get worse, I don't know, but some of these stocks look like they're just so washed out. I'm starting to see some of these stocks that they look like they're so washed out. And this is a good example. Like, this could potentially be building a base here. And obviously it could break down from this bull flag here, but this is an ETF, and they're actually, what's cool about it is they're transparent, and they show what they hold and what they buy and sell every day and all that, and it's kind of cool. But um, you really got to this is the poster child for basically for like the new paradigm. And obviously prior to, I can't go back any further than this, but prior to the pandemic sell-off, this was the big thing. But also, this is where the speculation came in. Zoom, like Zoom is one of their big holdings, and they put out some report about how Zoom was going to 1,500 or something in 5 years. I forget what it was, but um, well, uh, these charts could just drive me crazy sometimes. But so here's the thing: I've been looking at this, been watching it, and it kind of did have a bottoming pattern, right? And I mean, these percentage moves are astronomical on some of these things. I see some of these stocks, and I mean, it's nothing for them to make like moves. Once they get beat down like this, the percentage moves get bigger. And so, here's one that that went up 40% off the lows, and then loses 25% in a short amount of time. It's just crazy. But that's it kind of had a bottoming pattern, and it still does, right? I mean, well, oh, annoying. There we go. This is kind of working on a bottoming pattern, I'd say. Right? And of course, overall it's in a huge downtrend, but this is the other thing that's sort of bugging me here is, let me see if I can do, okay, this is going to work. Yeah. So on like these charts, like when you click this thing, you have to select trend line, or else if you start doing something, it just drags it around. So I'm learning a little bit about how to use these things. So anyway, it's kind of an interesting bottoming pattern, other than the fact that it's starting to fail right here. And so obviously, there was a little bit of a trade on that trend line break, and I'm starting to wonder if we should tweak things a little bit in our system to to make, because there's the problem that we're running across, and we've been running across all year, is that so many stocks are in downtrends, that trying to find stocks that are having pullbacks and uptrends, and like a typical swing trade pattern is more difficult because the majority of stocks are in downtrends, right? And then I've been saying for a while that a pullback in energy and materials might create some swing trade setups, and it still might, except for instead of a typical pullback, I mean, these things they collapse. Right? And so, I mean, rallies have been suspect since the beginning of the year. Oh, which reminds me, the JO finally succumbed and got stopped out yesterday. It was actually the day before, it was within a dime of hitting the stop. And so, that was one that I've never particularly cared for that. Over the years, we've had that as a swing trade multiple times, and it's about half the time it works, half the time it doesn't. But it was reasonably tame enough as far as percentage moves, and it held up pretty well during a lot of these sell-offs. But I had a feeling that since all the other commodities seemed to be selling off, that it wasn't gonna make it. And so anyway, it was the one open trade we had. But on a positive note, it was like 9% stop. It was kind of a tight stop in these markets. I mean, back in the old days, I used to like to use like really super tight stops, 5, 6%, 6, 7%, 6, 7, 8%. I think William O'Neill, in his book How to Make Money in Stocks, which I read decades ago, was I think he said 7%, cut your losses at 7%. But anyway, Um, when a trade doesn't work out, if in this sort of environment where these kind of, I mean, look at the range on this thing just in the past couple of weeks, right? Or even the past couple of months, This is 20, the ranges on these things are just insane on just a lot of stocks, and not just Zoom, although, you can see that you're talking 22%, 20% gyrations up and down in the normal swings. And so, man, that's tough to, I mean, that's really tough to, you can't use a 5% stop when you got a stock that's moving 20%, on the up and down swings. Now you can, something like this, you can try and catch bounces on it for real quick trades, and this and that. So I mean, it's good. There's lots of good trading stocks like this, but longer term, there's every possibility that this thing could carve out a bottom and come up. But my original point was this: is that let's take what I was talking about before, the energy. Um, yeah, this energy too has potential to, and a lot of the energy stocks look very similar to this, just straight down, one bounce, lower low. These have potential to sort of carve out a low. Like you can see a sell-off back here, last July, and I mean it was weeks and weeks and weeks of consolidation, one more leg down, and then it started the rally. And so that's one of the things, like I was talking about, newer investors being conditioned to try and, call bottoms and buy dips and all that. What you learn over the years is that, true lows take a long time to form and manifest, aside from V bottoms. I mean, we have seen a lot of V bottoms, and so that's another thing. The V bottoms tend to get people lulled into this thinking, false sense of complacency, where they think at some point, the market's going to stop going down, it's going to turn around and just rocket higher and be right back to the highs. So energy is kind of the thing to watch. This brings me to another point: is, I mean, look at the rally that happened in June. I guess we could look at the price of oil, but anyway, now that these commodities and oil have come down, that 9.1 CPI print probably, quite possibly is going to be the high print. That's not going to stop the Fed from raising rates, right? Because theoretically, they said, Powell said, and the Fed minutes say that they want to see inflation come down considerably, over multiple data points. Like the first, if the next inflation prints in the, sevens or whatever, if it's in the sixes, sevens, or eights, they're not just going to stop raising interest rates. Although, the market, if you pay attention to that stuff, the market's pricing in, a certain amount more rate hikes, and then a terminal rate where they're no longer, going to be raising rates. And so the thing about it is, the worst thing about inflation is this. I mean, there's lots of bad things about it, but here's where basically what nobody talks about is that once the rate of inflation starts coming back down, that doesn't mean that they're going to lower the price of everything. Like all this stuff where, all these prices that went up at the stores, the grocery store, and the prices, all this stuff, they're not going to start lowering them. If the rate of inflation comes down, I mean the price of stuff is still going to be elevated. It's just not going to increase as much and or as frequently. So we're still screwed because the inflation already happened. The price of everything went up and is going to stay up. And so, yeah, it's a bad situation. But anyway, the price of, since the cost of gas at the pump, which I believe was $4.46 here yesterday, we never hit $5, amazingly enough. and obviously it's a location thing, but we got up to like 489 or 491 or something like that, and then that was it. And so anyhow, let's see. We have a couple of pending trades, and I expect that what now we're getting into the thick of earnings season too. So this PSX, I mean, this looks very similar to XOP. Honestly, it's got a similar look to it. This would have to carve. This needs to carve out a bottom and rally on the other side, which is, I mean, we're talking. I don't know. Hey, sometimes these things they just V bottom and turn right back around. But my guess is that you know if this carves out a bottom in this area and then starts to come back up, I mean we're looking at a long time. I mean things you never know. I mean some stocks they just turn right around and kind of V bottom out and start rallies again. Here's XLE. XLE is actually in a pretty interesting spot. It's kind of tanked down. It's right on top of the 200-day moving average, which as you can see, let's see, we go back for a ways. Go back for, let's go back to the pandemic sell-off, right? I wanted to see about that 200-day moving average. So, yeah, there's the pandemic sell-off and all that time, and then boy, it broke above it. When it broke above that 200-day, that's a pretty nice uptrend. This sell-off is awful steep, and of course, nobody wants to see the price of oil go back up. It's a big contributor to the this crazy inflation we're seeing. So, Um, you know, all it would take is like the Rush peace in Ukraine, right? Is that too much to ask for? That if that war was over, man, you would see the price of oil tank. You guys remember when was it? Oil went negative on the futures. I remember when oil was like, speaking of that, WTIC. There we go. Just for the fun of it. Just for the fun of it, right? And I don't think, so the over and under on oil is $100, and the funny thing is, the argument now is whether the price of oil has sold off because, of demand destruction, right? I mean, people just aren't going to drive as much. They're just not. They're just not going to drive as much if oil's, close to $5 a gallon. And I'm the same way. I mean, if $5 a gallon, then it's a psychological thing, So at $4 a gallon, then I'm thinking, okay, well, I can live with that. But at $5 a gallon, people will cut back. And so I used to think that the threshold was four, between 3 and 4, but you get conditioned over time to rationalize certain things. But anyway, a lot's going to hinge on this. Now that the price of oil is back below $100, if it continues to drop for whatever reason, if it continues to drop, then those energy stocks or whatever probably continue to come down. And inflation the rate of inflation. Everybody likes to call it inflation. I like to call it the rate of inflation because that's got a little bit different sort of meaning, right? When you say, oh, the price of such and such went up because of inflation, it leads people to think that, okay, well, if inflation comes down, then, the price of that thing that went up is going to come down too. But see, it goes back to what I was saying earlier. That's not true. It's the rate of inflation. And so when the rate of inflation begins to decline, you're still going to pay the high prices for whatever went up. And and the other really insidious thing about inflation, obviously you've heard that it's a tax. It's basically a tax, that affects poor people. it affects everybody, obviously, but it hurts poor people, I guess I should say, because they're on the margins, right? Paycheck to paycheck, and when the price of stuff goes up, I mean, and obviously wages have not kept up with inflation, and so it's a mess. And so, um, and I pretty much think that the Fed bears the bulk of the responsibility. Now, obviously, supply chains and Russia and all that kind of stuff are contributing factors, COVID, all that, but the Fed and their unlimited cash or whatever, I believe, is the main should bear the main responsibility for the inflation that we're seeing now. And so, and like I said, I saw it coming a mile away because the price of everything, the cost of living, and the price of everything's been going up my whole life. And so you see prices go up, and then you see the Fed pretend there's no inflation, so it's nuts. But I would say that housing aside, owner equivalent rent and all that, I'm going to say that the price, and I've been saying this, the price of oil is like really the number one contributing factor because everything gets moved around on a truck. Everything that you buy gets to the stores on a truck, and if the price of gas is going up, then that's going to filter through the economy. And so we're seeing a little bit of relief here. And so as much as I hate to agree with Kramer on something, he's got a point when he talks about the price of oil and energy and all these commodities having come down over the last month. And so, the big thing, like I was saying before, is what's priced in. Is a 75 basis point rate hike priced in? Is lower energy priced in? What's priced in the market? Geez, I don't know. I mean, it's hard to know. Let me see if I got the right chart here. Oh, there's another. I accidentally clicked on the wrong chart. I didn't intend to, but this is another fun chart with trend lines. This is a weekly chart, as you can see, and I drew this trend line across these two lows, which happened to coincide with this low. I talked about this a few weeks back, and so I mean, there's so many trend lines you can draw on a chart. Whether they're meaningful or not is remains to be seen. But here's the one thing: is it's a law of physics. Like the one thing I like about trend lines is this, like it's a law of nature. It's a law of physics that the S&P has to get above this downward sloping trend line in order to get back to the high. I mean, nobody can debate that. Nobody can argue with that. And so, you know, and so anyway, that's what sort of validates, in my opinion anyway. And I mean, that's what technical analysis is sort of built on to some degree. I'm not a huge fan of extremely esoteric technical analysis, although I find it fascinating, and some of the stuff I believe does have some validity. Um, However, in its most basic form, like this, what I just said there, it's a absolute fact, undebatable law of physics that the S&P 500 cannot get back to the highs without breaking above this trend line. And so, I mean, that's just, perspective. And that's why people draw trend lines. And, the other thing, and this is the lower trend line is way more subjective because I just happen to think it would be interesting to draw it across these two lows. And lo and behold, when I extended it out, it coincided with this low. And so, the lower trend line is very subjective. But what I can tell you is if the market breaks below that trend line, people are going to be freaking out because, and that's, like I said, it's subjective, but every possibility. We're a lot closer to that trend line than this one. So interesting consolidate. I love the weekly charts. I mean, the daily charts. The daily charts basically, are for one purpose, but the weekly charts give you the bigger picture. And so, and the monthly charts too, man. I look at monthly charts all the time. I love the end of the month because the monthly charts, which I'm not going to pull up here, but anyway, this little consolidation right here, um, the market looks kind of vulnerable. It looks vulnerable until it gets back over 4,000, right? And notice that big 2-week sell down. So there's a lot of bad stuff going on out there in the world. The macro picture is pretty darn ugly. It really is. Hey, you remember like the old saying, 3 steps and a stumble? I mean, that's been around for I don't know how long, but I remember it, from 30, reading about it 30 something, 40 years ago. The don't fight the Fed, 3 steps and a stumble means that when they start embark on an interest rate hiking cycle, that, look out below in the market. The market's not going to just, be as easy. Stock, the whole stocks always go up thing is, with that said, when stocks go down, when the market goes down, it always presents a buying opportunity out in the future. The trick is to not try and be like a kid in a candy store on every dip. And so our system is just it's just not finding a lot of stuff that looks like it's putting in a potential bottom and is ready to turn back around and go up. And so that's why year to date, I mean, there's only been a handful of trades, and they haven't been able to buck the trend. So, I mean, if we were, if we were day trading, if we were, catching intraday bounces, whatever, there'd be, there's a lot to work with. But, the type of traditional swing trades where, you get a pullback and then you bottom out and then you swing back up. That's just, they've been kind of few and far between, but at the same time, we haven't experienced the kind of damage that, a lot of people have. So anyway, with that, I'm going to wrap this up, and looks like the market kind of wants to retrace a little bit here today, getting a pretty decent rally. And so, everyone's going to rationalize. And hey, maybe we'll see a little bit of a higher low here. But just keep this little, the last couple of weeks, this little range here. We consolidate in that range, and then it's going to break one way or the other. Anything below 4,000, I think, is still sort of bear market. And then, of course, 2 weeks from today, we'll see what's priced in, and we'll see what the Fed does. So anyway, thanks for tuning in. I will